home sales have virtually frozen, right?
Yeah, yeah.
Mortgage rates are sitting near these just punishing multi-year highs.
Yeah, the whole sector is essentially holding its breath right now.
Exactly. And yet somehow against all of that, Home Depot is actually beating Wall Street's expectations this morning.
It's wild.
It really is. Welcome to the Bulls, Bears, and the Bell podcast. It is Tuesday, August 18th, 2026. It is 6:04 a.m. on the East Coast.
Sun is barely up in New York, but the money is already moving.
Oh, absolutely. And we are jumping straight into today's deep dive because we are unpacking a massive stack of pre-market financial research, overnight global index data, and these corporate earnings that are honestly sending some wildly contradictory signals across the board.
Yeah, totally mixed bag today.
Right. So our mission before the opening bell rings is to, synthesize all this noise. We need to figure out if the global consumer is finally breaking under the weight of these high borrowing costs, or if maybe they are simply executing a highly strategic retreat.
And that strategic retreat, I mean, that's really the core tension in the markets today, isn't it?
I think so, yeah.
Because we are operating under this dominant macro narrative of higher for longer. Following the Federal Reserve's decision to just hold rates steady back in July, the market has essentially surrendered to the reality that, the cost of capital is not going back to zero anytime soon.
No, the free money era is over.
Right. Over and done. The Fed is staring in the rearview mirror at inflation, and they are keeping their foot hovering right over that brake pedal. But the data we are getting this morning from Tokyo, from Europe, and these domestic earnings reports, it's really testing whether the global economy can actually sustain this altitude without just stalling out.
Well, and the surface level metrics suggest this almost eerie calm, right? Like if you look at the S&P 500 futures this morning, they're actually up just slightly.
Yeah, about 0.12%.
Exactly, trading near 5,945. And more importantly, if you look at the VIX, it's sitting at 14.64.
Which is suspiciously low.
Incredibly low. The derivatives market is actively pricing in stability here. It's signaling that institutional traders, they just aren't hedging against any massive imminent downside moves.
Right, but when we actually look at the overnight data, that surface level calm is masking some severe structural stress.
No, absolutely.
I mean, to understand how Wall Street is going to open today, we have to look at the global handoff from the Asian and European sessions, because the global liquidity engine, it took a really significant hit while the U.S. was asleep.
It took a beating. Let's start with that structural handoff from Asia, because it was particularly brutal this morning. Japan's Q2 GDP growth came in at 1.1% annualized.
Which is a big miss. The street was forecasting 1.67%.
Right, a massive miss. And we saw the Nikkei price immediately dropping 0.4%. But the headline number isn't really the story here, is it?
No, not at all. The underlying mechanism causing that miss is this severe contraction in domestic consumption. The Japanese consumer is just aggressively pulling back on discretionary spending because, well, their real wages are getting completely devoured by import costs.
So let's follow the mechanics of that for a second. Because a sluggish consumer in the world's fourth largest economy, that is not just a localized problem.
Far from it.
Right. If domestic demand in Japan is collapsing, that forces the Bank of Japan's hand. They've been trying to normalize their monetary policy, trying to walk away from decades of negative interest rates.
Which has been a very delicate dance.
Extremely delicate. But a GDP miss of this magnitude essentially traps them. They cannot hike rates into a contracting consumer economy without risking a severe recession.
And that trap, that is precisely why Wall Street is so heavily invested in this specific data point today, because it all comes down to the mechanics of the yen carry trade.
Yes, the infamous carry trade. Break that down for the listeners.
So for years, hedge funds and institutional investors have used Japan as basically a zero-interest credit card. You borrow yen at essentially 0%, you convert that capital into U.S. dollars, and then you deploy it into high-yield assets.
Like 5% U.S. treasuries or, high-growth tech stocks.
Exactly. It is free liquidity for global risk assets. As long as the Japanese interest rate stays at zero, you are just printing the spread.
Right.
But the second the Bank of Japan raises that rate, the cost to service all that debt spikes. And that forces institutions to sell their U.S. tech stocks to cover the margin call.
And we've seen how violent that unwinding process can be, right?
Yeah.
Just when the BOJ even hints at hawkish policy, the markets freak out.
Oh, completely. Which creates this incredible paradox today.
How so?
Well, the failure of the Japanese consumer to meet GDP expectations is fundamentally bad news for the global economy. It signals demand destruction.
Right.
But for a portfolio manager in New York holding heavily weighted tech equities, Japan's economic stumble is a massive relief.
Because it delays the rate hike.
Exactly. It means the Bank of Japan has to hold off, which preserves the carry trade and keeps that cheap liquidity flowing straight into U.S. markets.
So bad news for the local consumer becomes artificial life support for global asset prices.
Nailed it.
But that localized sluggishness, it isn't isolated to Japan. If we look over at China, the Hang Seng Index closed down 0.2% overnight. And the internal data there presents just another massive contradiction.
Yeah, the copper situation.
Right. We're seeing localized aggressive strength in industrial metals, specifically copper, but the broader equities market is sinking.
Yeah, and that copper strength, I mean, that is purely a reflection of state-sponsored infrastructure and manufacturing stimulus. Beijing is basically trying to build its way out of an economic slump by funding industrial capacity.
Because copper is the essential conductive material for, well, everything, right? From EVs to AI data centers.
Right, so the industrial demand remains really robust, but that state-level spending is just not trickling down to the household level. The Chinese consumer is hoarding cash. Exactly. They are not buying the end products that the manufacturing sector is so heavily subsidizing right now.
And that structural imbalance, manufacturing capacity accelerating while end consumer demand just evaporates, that eventually collides with the global supply chain.
It has to.
And the energy required to fuel that industrial capacity brings us right to the European session.
Where things are looking pretty stagnant.
Very. Markets in Europe are trading functionally flat this morning. The DAX in Germany is up 0.1%. The Key 40 in France is down 0.1%.
They're just paralyzed.
Paralyzed by sticky Eurozone inflation, which just ticked back up to 2.9%. And the primary mechanism driving that inflation is sitting right in the commodities market. Brent crude is pushing north of $91 a barrel this morning.
Yeah, and sustained oil prices above $90, that completely alters the inflation calculus for central banks.
Because it's not just the price at the pump.
Right, exactly. When Brent crude holds this level, largely due to escalating Middle East tensions, it compresses the profit margins of the entire global logistics sector. Ocean freight, air cargo, trucking, I mean, they all operate on razor-thin margins.
Right.
For the first few weeks of an oil spike, sure, companies might absorb the cost, but as this $91 floor holds, logistics providers have to activate fuel surcharges.
Now those get passed down the line.
Exactly. Those surcharges get passed to wholesalers, then to retailers, and finally to the consumer on about a 3-month lag.
So the European Central Bank, and by extension our Federal Reserve, they're essentially trapped. They raise rates to kill demand-driven inflation. But $91 oil, that is supply-side inflation.
Yeah, you can't fix that with interest rates.
Right. You can raise interest rates to 10%, and it won't produce a single extra barrel of crude or resolve a geopolitical conflict. The central banks are fighting a supply shock with a demand tool.
And that mismatch is exactly why the quote-unquote inflation relief trade is dying.
Right. The assumption that central banks had won the war and were preparing to just aggressively cut rates, that's rapidly unwinding today.
Yeah, because if the lifeblood of the global supply chain costs $91 a barrel, the floor for consumer inflation is just structurally elevated, period.
So if sustained energy costs are applying this delayed tax on global logistics, and the Asian consumer is already exhibiting severe fatigue, we have to look at how the U.S. and global corporations are actually navigating the squeeze.
Which brings us to the pre-market corporate earnings.
Exactly. And we are seeing a profound bifurcation in how consumers are allocating their remaining capital. The most striking example out of the gates today is Baidu, ticker BIDU.
Often called the Google of China.
Right. And they are down 2.3% on their print this morning.
And the internal architecture of Baidu's earnings report, it perfectly maps onto that macroeconomic data we just saw out of the Hang Seng.
How so?
Well, Baidu is actually demonstrating significant, measurable growth in their artificial intelligence monetization. The enterprise sector, so businesses buying cloud computing and AI tools to optimize their own operations, they're spending heavily. The tech investment cycle is completely intact.
But their core revenue engine, which is search and display advertising, that's taking a massive hit.
Exactly.
Because advertising is fundamentally a bet on future consumer spending, right?
Yeah.
If corporations look at the Chinese consumer and realize they are hoarding cash and pulling back on discretionary goods, the very first line item they cut is their marketing budget.
Obviously, you don't pay for digital real estate if the foot traffic isn't converting at the register.
Exactly. But then, contrast that broad consumer pullback with the earnings from Amerisports this morning, ticker AS.
Oh, this was fascinating.
Right. They are up 3.2% in the pre-market following a massive beat. And they are not selling household essentials. They sell premium outdoor gear, high-end technical apparel, luxury ski equipment.
Yeah, so if the core consumer is getting squeezed so hard by inflation that global advertising budgets are shrinking, how do we explain a 3.2% pop for a company selling $1,000 technical jackets?
Logically, luxury sporting goods should be the first discretionary category to collapse.
Right, but it comes down to the mechanics of a K-shaped economy. We no longer have this monolithic, quote-unquote, global consumer. We basically have two distinct economies operating in the exact same geographic space.
The two arms of the K.
Yes. The top arm of the K represents higher-income households. Their wealth is not entirely dependent on their monthly salary. It's tied to asset prices.
Right. Their portfolios.
Exactly. Their equity portfolios have surged over the last 18 months. Their home equity is at record highs. And if they own bonds, well, they're pulling in 5% yields and passive income. They are completely insulated from the sting of $91 oil.
They are essentially spending the yield on their assets, not the principal of their labor.
Precisely. They have the discretionary liquidity to buy premium technical gear and luxury experiences without even blinking.
Wow.
But then you have the bottom arm of the K. That represents the core consumer, whose primary source of wealth is just their hourly wage. They are absorbing the full impact of compounding inflation on groceries, rent, and fuel.
And they are the ones cutting back, which forces companies to slash the advertising budgets that ultimately drag down Baidu.
Exactly. It's two totally different worlds.
Which brings us to the anomaly of the morning, right? The earnings report that forces us to re-examine our assumptions about the U.S. economy. Home Depot ticker HD is up 1.4% pre-market.
Beating Q2 consensus on both the top and bottom lines.
Right. So if high-end consumers are buying premium ski gear while the middle class cuts back on basics, how do we explain the anomaly of home improvement? Because logically, with housing transaction volumes practically frozen by high mortgage rates, hardware stores should be warning of severe revenue misses, not beating expectations.
Yeah, to understand the Home Depot beat, you really have to break down their revenue model into two distinct channels. You have the pro segment, which is professional contractors and home builders, and then you have the DIY segment, the everyday homeowner.
Okay.
Historically, major hardware chains rely heavily on that pro segment for volume. When new home construction is booming, contractors are just clearing out entire aisles of lumber, plumbing, and electrical supplies.
But we know that new home construction and existing home turnover have slowed to an absolute crawl. The pro volume have to be taking a hit.
It is taking a hit, but the margins in the hardware business are super counterintuitive. The volume might be in the pro segment, but the highest profit margins are actually in the DIY segment and smaller scale remodeling materials.
Interesting.
And that DIY segment is currently being artificially supported by the lock-in effect.
Ah, the lock-in effect. Let's explore the mechanics of that for the listeners. Because during the pandemic, millions of Americans refinanced or bought homes, locking in 30-year fixed mortgages at roughly, what, 3%?
Yeah, 3, maybe 3.5.
Right. And today, the prevailing rate is hovering near 7%. So if you want to move to a slightly larger home, the principal on the new house might be manageable, but the interest expense on that 7% rate will literally double or triple your monthly payment.
You are economically trapped inside your current floor plan.
Exactly. Because you cannot afford the friction costs of moving. That pent-up desire for a better living space just gets redirected. Instead of upgrading the house, the consumer upgrades the kitchen.
Right. They remodel the bathroom, they build out a deck.
Yeah. And these are smaller ticket items compared to buying a new property. But for Home Depot, selling premium paint, high-end fixtures, and patio furniture to a captive DIY consumer yields significantly better margins than selling bulk 2x4s to a contractor.
So the paralysis in the housing market is actually creating a captive revenue stream for home improvement retail. The quote-unquote, I'm stuck here, so I might as well make it nice economy, is keeping the value trade alive even as the macro environment screams recession.
It's fascinating. But Home Depot's resilient remodel revenue points directly to the underlying cause of this entire dynamic, which is the frozen housing market itself.
Yes, the elephant in the room.
And today is being unofficially dubbed Housing Tuesday on the street, because we are facing a data dump that will serve as the ultimate stress test for the American real estate sector.
The timeline today is incredibly critical. At 8:30 a.m. Eastern, we get U.S. housing starts and building permits. The consensus is looking for 1.35 million starts.
Right.
And this metric tells us exactly how confident homebuilders are about future demand. Are they breaking ground or are they pulling back? Then at 10 a.m., we get pending home sales, which measures the contract signed but not yet closed. It's a vital forward-looking indicator for transaction velocity.
And then, to bookend the day, we have Toll Brothers ticker TOL reporting earnings post-close. Toll Brothers caters to the luxury housing market, right? That top arm of the K-shaped economy we discussed earlier. They are trading flat in the pre-market right now, but their forward guidance will serve as the final verdict on whether even the wealthy are starting to balk at these interest rates.
Absolutely.
But all of this housing data is colliding with a very specific technical threshold in the bond market today. The 10-year Treasury yield is sitting at 4.22% this morning.
And the 10-year yield is the foundational metric for global finance. I mean, it influences every other borrowing cost, from corporate debt to your 30-year fixed mortgage.
Yeah.
The pre-market research notes highlight a specific danger zone today. If today's housing data comes in hotter than expected, indicating the economy is still running too fast, it could push that 10-year yield up toward 4.30%.
Okay, let's break down the mechanics of why 4.30% is the trigger point for a potential massive sell-off in growth and tech stocks. Why does a basis point move in a government bond suddenly crush the valuation of a software company?
It comes down to how Wall Street models valuation using discounted cash flow.
The DCF models.
Right. High-growth tech companies are valued based on the profits they are expected to generate 5, 10, or 15 years in the future. To figure out what those future profits are worth in today's dollars, analysts apply a discount rate. And that discount rate is pegged directly to the 10-year Treasury yield.
So if the 10-year yield rises to 4.30%, the discount rate goes up.
Exactly.
And mathematically, a higher discount rate severely shrinks the present value of all those future earnings. The underlying software company didn't lose any customers overnight, but their stock plummets simply because the cost of capital made their future cash less valuable today compared to the guaranteed risk-free return of a government bond.
Precisely. The duration risk on these tech stocks is incredibly high right now, but the dynamic has become so complex because Wall Street's reaction function to economic data has completely inverted over the last few weeks.
Oh, I really want to dig into that inversion, because for the last 2 years, the market operated on the logic that bad economic news is good market news, right?
Right.
If housing starts missed the mark, or if jobs data came in weak, the market would rally. The logic was that bad news would force the Fed to cut interest rates, thereby lowering the discount rate and boosting stock prices.
That was the playbook.
But reading the institutional notes this morning, if housing starts miss the 1.35 million consensus at 8:30 a.m., traders are actually bracing for a sell-off, not a rally.
Yeah, the tone has shifted.
Why has a miss in housing data suddenly reignited recession fears instead of triggering celebrations about an impending rate cut?
Because the market realizes the Fed put might be dead. We have transitioned from fearing inflation to fearing a hard landing.
Right.
The Fed has held rates high for so long to kill inflation that investors are now terrified. The structural damage to the economy is actually irreversible. A soft landing requires the Fed to cool inflation without triggering mass layoffs.
But housing is not an isolated sector. It's a massive multiplier for the broader economy.
Exactly the issue. If builders pull back on housing starts, it doesn't just mean fewer homes are built. The multiplier effect kicks in. Construction workers are laid off. Lumber mills scale back shifts. Appliance manufacturers see orders evaporate. Mortgage brokers lose commissions.
It's a cascade.
Yes. If the housing data misses hard today, it signals that the contraction is cascading. A slight cooling proves the Fed's medicine worked. A sudden drop proves they accidentally killed the patient.
The margin for error is functionally zero at this point.
Literally zero.
So before the bell rings, let's recap the mechanics of this incredible balancing act the market is performing today. We have a Japanese GDP miss acting as artificial life support for global liquidity by delaying the BOJ's unwinding of the carry trade.
Right.
We have $91 Brent crude acting as a delayed structural tax on the European supply chain, forcing logistics companies to pass margin compression onto a fractured consumer base.
And domestically, we have a starkly K-shaped economy where high-end discretionary spending remains robust, while the core consumer pulls back so hard it damages ad revenues.
Yes.
Yet, anomalies like Home Depot's margin-rich DIY beat prove that consumers are finding strategic ways to deploy capital within the strict confines of that lock-in effect.
So for you listening this morning, this data cascade directly impacts how your capital is going to move over the next 6 months. Whether you are actively managing an equity portfolio, looking at the structural floor for your gas and grocery bills, or just waiting for the mortgage market to finally unfreeze, today's specific combination of energy shocks, retail bifurcation, and the impending 8:30 a.m. housing metrics will absolutely dictate the Fed's playbook.
Yeah, they're watching this closely.
If the consumer proves too resilient, the Fed holds rates higher, risking a delayed fracture. If housing collapses today, the Fed may be forced into an emergency posture.
Every single data point we get today is a leading indicator for the cost of capital for the remainder of 2026.
Which brings us to one final lingering anomaly for you to consider as the market opens today. We started this deep dive by looking at the VIX, sitting practically asleep at 14.6 4-day. We have $91 oil compressing logistics margins, a Japanese central bank trapped by domestic contraction, a K-shaped consumer base retreating into defensive spending, and a 10-year yield sitting just basis points away from triggering a massive tech multiple compression.
And yet, with all of that going on, the options market refuses to price in any significant downside protection. It's wild.
It really is. So the question you need to ask yourself as the bell rings is this: is the institutional market brilliantly looking past all of this macroeconomic noise, mathematically confident that the Fed will achieve a perfect soft landing? Or is the derivatives market dangerously mispricing structural risk, taking a nap on the beach while a hurricane brews just offshore?
We'll see how that 14.64 number moves.
Exactly. Watch closely how that number moves, especially as tomorrow's FOMC minutes hit the tape and reveal just how nervous the central bank really is behind closed doors. That is all the time we have for today's pre-market deep dive. Thank you so much for listening to the Bulls, Bears, and the Bell podcast.
Make sure you subscribe.
Yes, explicitly telling you right now, go subscribe on Spotify or your favorite podcast app so you never miss a beat. We'll see you tomorrow morning before the bell.